All right, so a little positive performance here in what will be another week with lots of earnings stories to watch for. The likes of Walmart and Home Depot set to report their numbers. But of course, we also have a key inflation reading in the United States. And everybody's been trying to figure out whether it's Canada or the U.S. or other central banks around the world, at what point the inflation fight makes enough progress that you can start to see a pivot towards interest rate cuts, and what happens to the stock market in all scenarios that we're watching unfold right now. Let's ask Brian Belski, he's Chief Investment Strategist at BMO Capital Markets. Brian, always great to see you. Thanks for the time.
Good morning, and good morning, Canada. Thanks for having us.
What's top of mind for you right now? I mean, how close are you going to be watching the inflation numbers this week?
You know, we're still very vexed on how anybody thought that the Fed was actually going to be raising rates. We don't understand that narrative, number one. Number two, you know, the path of inflation has been improving in terms of going down for quite some time. We've had over the last 30 to 60 days some increasing commodity costs that may actually see a bit of a reversal on a near-term basis that could potentially spook the market this week. But the trend is your friend, quote unquote, with respect to inflation overall. But I think there's too much talk, Jonathan, in terms of interest rate cuts. What if the Fed doesn't do anything? You know, historically, you know that the Bank of Canada traditionally moves first in all three directions, meaning pauses, cuts, and raises. So the likelihood of the Bank of Canada cutting first, we think, remains very strong.
And against that backdrop, how are you investing? What's your advice to our audience right now?
You know, we think stocks are higher at year end. You know, our bull target for the S&P 500 that we published in November of last year is 5,500 on $250 of earnings. You know, we still think that on the bull side is very plausible. We do believe that on a near-term basis, there's a little bit too much froth. We'd like to see an opportunity to buy stocks a little bit cheaper. We've seen very promising activity in the Canadian markets. Canada is kind of following suit, which has been our call now for the last decade or so. As America goes, so goes Canada. And it's nice to see at least two out of the three big sectors, meaning materials and energy, kind of prop up here after rougher years last year. Financials still kind of seem to be in a bit of a conundrum, but Canadian financials are ending up being much more of a stock picker's market that we've seen in several years.
One of the comments we heard from a guest this morning on the Canadian financials, and this is someone who likes U.S. financials, larger U.S. financials over Canadian financials, is if the bond market gets a little problematic in equity market terms, if there's some unease on what happens with interest rates, that becomes more of a complicating factor for Canada's mortgage market, just sort of creates more complications for the Canadian banking sector. How do you feel about that?
I think that's a pretty consensus call. You know, I think it's really dangerous when equity people make fixed income calls and fixed income calls make equity calls. I think that, and our call has been that you're going to see flat interest rates for the next several months, if not quarters. And I think that's a pretty good environment with respect to both financials and the markets overall. So I think that actually could do quite well.
Now, I'm looking at the year-to-date performance in Canada in the real estate sector, and I see negative performance for that sector group. Obviously, a lot of people thinking about the interest rate environment. When I look at the S&P 500, I see all of the 11 subgroups, 10 of the 11 subgroups in positive territory for the year, and then real estate as a group, the one laggard overall. How do you view that? Do you see any opportunity in that?
Yeah, I mean, you know, we like to be contrarian as strategists, Jonathan, our entire career. And the best time to be a contrarian, quite frankly, is when the analysis backs it up. When everyone's thinking one way, but the analysis backs it up. And what's the analysis on REITs? Well, if you take a look at relative performance compared to the market, relative valuation and absolute valuation relative to the market, earnings growth, and then lastly, operating performance. So that's really the four pillars of our process in terms of looking at stocks, industry groups, sectors in the market. And we think that REITs are way overdone. We think they're way too negatively kind of treated. But I think what people are missing, according to our work, is that REITs, both in the US and Canada, quite frankly, do quite well in a higher interest rate environment. I think this 4 to 5% 10-year Treasury range is going to be here to stay. And REITs have historically done much better than, let's say, telecom in Canada, financials in Canada, utilities in Canada especially, but also in the United States do very well in this higher interest rate environment.